What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. So today we're going to talk about whether or not a 1031 exchange makes sense for your property and how to approximate the tax liability or the potential tax savings when you're using a 1031 exchange. So to get started, let's just briefly review what a 1031 exchange is, and we'll talk a bit about the rules that go into that. We've done previous podcasts discussing 1031 exchanges, so you may want to refer back to there for a bit of a refresher. But in short, a 1031 exchange allows you to defer paying capital gains tax and depreciation recapture when you sell an investment property. Now, in order to defer, you have to reinvest the proceeds into another property that qualifies as like kind. Now, in this case, like kind simply means real estate for real estate. You can exchange a single family home for an office building or exchange raw land for an industrial warehouse. As long as it's real estate for real estate, the like kind test is met. Now, one exception to that is domestic, like US based real estate versus foreign. So US to US real estate's like kind, and then foreign to foreign is like kind, but you can't go US to foreign real estate. Now, the current rules tell us that you must exchange business or investment real estate for other business or investment real estate. You must also use a qualified intermediary to handle the funds. So you can't have access to the proceeds in any way during the entire exchange process. The qualified intermediary is going to receive the funds from the sale of your property, hold them until you acquire the replacement property, and at which time they distribute the funds at closing or settlement. There's also the two timing rules to deal with. We have the 45-day rule, which gives you 45 calendar days to identify your replacement property. Typically, up to 3 replacement properties will be identified, and you have to close on one of those. So the clock starts when you sell your relinquished property. That's the property you're giving up in the exchange. The identification is sent in writing to your qualified intermediary. That's proof that you met the 45-day rule. Now, the second timing rule is the 180-day rule, which gives us 180 days. This runs concurrently with the 45-day clock. It's 180 days to complete the entire exchange. It's 180 days or the due date of your tax return, which includes extensions. So if that 180-day window goes out past April 15th, you generally want to extend your tax return to give yourself the full 180 days to complete the exchange. Now, the timing rules are typically one of the most difficult parts of a 1031 exchange. Circumstances beyond your control can cause delays and can cause you to lose out on completing the exchange and therefore the tax deferral. That's why it's important to understand your options and be careful with timing going into the exchange process. So first, you want to explore all your options. Then if you decide you're going to move forward with the exchange, have everything lined up. Have your 3 replacement properties ready to go before you sell your relinquished property, the property you're giving up. So little things like that can really work in your favor to help complete the process and defer taxes. But when you're first considering a 1031 exchange, you always want to check your most recent Form 8582. This form is going to tell you if you have any suspended losses hanging out there that can be used to help offset the gain if you were to sell the property outright rather than do an exchange. So if the suspended losses can offset all or most of your gain, you might be better off selling and using the losses rather than doing a 1031 exchange. Now, maybe you have other plans for those losses in future years. You've got a tax plan in place and a 1031 exchange still makes sense, then by all means do it. You just want to make sure you understand your options going into the whole process. Another consideration is to sell your property and within the same tax year, buy a new property, have a cost segregation study done, and use bonus depreciation to really enhance your year one losses, which can then be used to offset the gains from the property you sell. So that's another option to help mitigate any gains on the sale of a property that you can use. You don't have There's some timing rules in place because it all has to happen in the same tax year, the sale and then the purchase of the new property. But depending on the time of year, this can give you a bit more time than doing a 1031 exchange. So you have multiple options. And one thing you don't want to do is go into a bad property just to save taxes. And I know that probably sounds like common sense, but I've seen too many times where a 1031 exchange, things just aren't moving along, and to get the exchange complete, taxpayers go into a property that's just not a property they really wanted. It's not a very good asset. And in the long run, this could actually end up costing you more money. So just be sure you don't go into a bad property just to complete the exchange and defer the taxes. Another thing to really consider and look at is what the actual tax liability would be on a sale. So the smaller the tax hit from a sale, then the less valuable the 1031 exchange becomes. So there's fees that you pay to a qualified intermediary. You're going to pay a bit more to your CPA when you perform a 1031 exchange. So you want to make sure the tax savings are actually there. Now, how would you estimate your tax liability? So the first thing you need to do is come up with your expected sales price for the property you're giving up. So if you're not sure what it would sell for, ask your real estate agent. Maybe they can give you a range. Use the midpoint if you have a range. We're dealing with estimates here, so that's fine. You don't have to be exact or precise. Next thing you need to do is estimate your selling expenses. Now, this can vary by property type. For example, a single-family home, generally selling expenses are going to run somewhere between 6 and 10%, depending on what part of the country you're in. So if you take your selling price minus selling expenses, that's going to be your net sales proceeds. Now, from here, once you know your net sales proceeds or estimated net sales proceeds, you need the original cost of the property plus any capital improvements that have been made since you acquired it. That this amount is your unadjusted basis. Unadjusted basis is the original purchase price plus any capital improvements you've made. That you can generally find this on your depreciation schedule from your most recent tax return. You'll also need the accumulated depreciation, your depreciation deductions taken to date, which can also be found on the depreciation schedule. So your unadjusted basis, that your original cost, including improvements, minus the accumulated depreciation, gives you your adjusted basis. The adjusted basis is what's used to calculate the gain. So your total gains calculated by taking the net sales proceeds minus your adjusted basis. That's your original cost minus depreciation. There are generally two parts to the gain. So you have your capital gain, which is your appreciation, any appreciation in the value of the property from what you paid for it, and depreciation recapture. So the net sales proceeds minus your unadjusted basis, your original cost, that's going to give you the capital gains portion. As long as you own the property for more than a year, the long-term capital gains rates are more favorable than ordinary income tax rates. They could be 0%, 15%, or 20%, depending on your income level. The accumulated depreciation portion, you're on real estate, accumulated depreciation on real estate. We're talking about standard real estate, 27.5 year or 39-year property. The recapture on that is taxed at a maximum rate of 25%. If your ordinary income tax bracket is under 25%, then the recapture is taxed at your ordinary income tax rate. So if you're in a 22% bracket, that depreciation recapture on the 27.5 or 39-year property will be taxed at 22%. If you're in the 37% bracket, it'll be taxed at the match rate of 25%. Now let's look at an example with some numbers to help illustrate this a bit better. Let's say you have a property that you can sell for $1 million. We're going to say the selling expenses are 6%, $60,000. You originally bought the property for $500,000, and so far you've taken depreciation of $200,000. So we would calculate 1 million minus 60% times 1 million, your selling expenses, 60,000. So 1 million minus 60,000 gives us a net sales proceeds of $940,000. So our unadjusted basis in this case is $500,000 we originally purchased the property for. We're going to assume no capital improvements have been made. And we've taken $200,000 of depreciation so far. So our adjusted basis is $300,000. $500,000 purchase price minus depreciation taken of $200,000 leaves a $300,000 adjusted basis. The taxable gain in this case is $640,000. That's our net sales proceeds of $940,000 minus our $300,000 adjusted basis. So our total gain, $640,000. We're going to split that into the capital portion and the depreciation recapture portion. The capital gain portion is $440,000. That's our net sales proceeds of $940 minus our unadjusted basis of $500,000. The depreciation taken so far is $200,000. So that portion is our remaining gain. That is what's subject to depreciation recapture. Alternatively, you could have taken the depreciation recapture of $200,000 and deducted that from the total gain of $640 to arrive at your $440,000 capital gain. So let's assume this taxpayer is in the 20% capital gains rate, and they're also subject to the maximum 25% recapture rate. The tax bill on this sale would be $138,000. $50,000 of recapture, that's our $200,000 depreciation taken time, or $200,000 of accumulated depreciation times 25%. And then $88,000 of capital gains. $440,000 total capital gain at 20% is $88,000. The two together come to $138,000. Pretty significant tax bill. And to keep it simple, we're just ignoring the 3.8% net investment income tax, which is typically going to apply to investors that are, if you're married and make over $250,000, this will apply. Or if you're single and make over $200,000, it's going to apply. An exception would be real estate professionals, which when you sell rental property and you're a real estate professional, you can avoid that 3.8% net investment income tax. Anyway, in this case, $138,000 tax bill, the 1031 exchange is generally going to make the most sense. You could defer all those taxes rather than paying them now, but everyone's situation is going to vary. This was just a simple example to kind of illustrate how that gain's calculated. Most of the information to calculate your gain is going to come from your depreciation schedule and then your expected sales price. That about does it for today. I hope you found value in this episode. If so, leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.